First, let me give you two facts. Fact 1. The most common fee scale of an investment bank on a merger deal is based on Lehman's 54321 formula. This means 5% is paid on the first $1 million of the sale price, 4% on the next million, 3% on the third million, 2% on the fourth million, and 1% on the amount over $4 million. For large transactions, the fees are less than 1% of the deal's value, still a tremendous amount of money. The second fact is that taking a company public can also be very expensive. Costs vary, but can be as much as 10% on a $150 million stock issue, not including internal expenses such as management's time. Some costs are ongoing, like the cost of Securities and Exchange Commission compliance. By now, I bet you have many questions in your mind. Why does investment banking make so much money? Why does investment banking require a top-notch education, stellar grades, and extremely competitive business analysts to do their jobs? What is investment banking? Is it investing? Is it banking? In this training program, we'll answer all your questions and learn the business of investment banking. We'll cover the specific industry jargon and go through what is the sell side, the buy side, what is investment banking, asset management, sales and trading, as well as hedge funds. Next, I'll walk you through some really important concepts in financial markets. The reason I'm doing this is that finance knowledge is not only critically important for finance job seekers, but also for anyone who's in business or wants to own a business. Understanding finance is the reality check for your business. Whether you're seeking for an investment banking position or you want to learn how to manage your money, become smarter and more aware of opportunities in your life, this course will apply to you. So, what are you waiting for? Let's get started.
Introduction. What you should know before watching this course. So what does a person need to know to take this course? Well, there are no prerequisites for this course. All you need is a willing heart and mind. Now, we will introduce you to a lot of new terms and concepts, but you can do this. You will bend your mind in ways that it might not be comfortable bending, but that's okay. This will be a little like exercise. First start out, it might hurt a little bit because you're working muscles that you haven't worked in a while, but eventually your body gets used to it. Well, the same is true here. We're going to work muscles in your brain that aren't used to being worked in this way, but that's okay. You'll get used to it, and you will get a sense of accomplishment knowing that numbers and theories just aren't that scary. So, there are no prerequisites for this course, but once you complete this course, you may find that you'd like to try your hand at other numbers courses, and you'll find plenty of those. Well, in this course, we're going to cover lots of area in financial market and investment banking. As such, depending on your personal needs, you might need to jump around the class a little bit. But we've put together a very clear outline so you can clearly find the different sections and choose what's going to work for you. I'm not going to assume that you already have some basic skills in this course, so everything will get started from zero. Last thing I want to mention is that these materials are copyrighted and may not be disseminated without express written approval from myself. All right, without further ado, let's jump in. Investment banking fundamentals. What is investment banking? When the credit crisis unfolded, I heard a lot of investors asking the question, what is an investment bank and how does it differ from a regular commercial bank? Unless you work in finance, the term investment bank likely did not present itself in your day-to-day life until the 2008-2009 global meltdown began. If you find yourself asking the same question, in this lecture, I'll explain the basic definition for you, give you a brief overview of what an investment bank does, help you understand the reasons investment banks are so important to the economy, and teach you how investment banks make their money. Investment banking is a misnomer. It's not banking and it's not investments. So what it is in banking is generally known as corporate finance, or finance for the corporations. Here, the investment bankers try to help a company, a corporation, manage their finances. For instance, capital raising assignments. Companies need capital to be able to reinvest back into the business for future growth. Therefore, they will issue equity as well as issue debt to fund these additional projects. In addition, investment bankers and the corporate finance analysts will also be advisors. For instance, on the mergers and acquisitions side. If you are in the investment banking industry, it is essential to know the difference between the sell side and the buy side. Yet the irony is that many of us are still unaware of these very important terms. Many a time, I have seen that students are not only confused between these two terms, but also about its usage in context of investment banking roles in the industry. And let's quickly go and define what the sell side is versus the buy side. Folks, the sell side is basically any side that sells. In other words, these are the investment banks who underwrite stocks and bonds. They are trying to push a product to now sell, and therefore, they are trying to access the capital markets to be able to push these products against that they are structuring and print together stocks, bonds, and MA as well as to sell something. Who is buying whatever the sell side is selling? The buy side, the buy-sell, or anywhere and anyone from the institutional investors, the asset managers and money managers to individuals like you and me who will go and buy particular stock. And these buy sides are going to be on the other side evaluating the products that the sell side has to sell. Now, what about the sell side analysts? A sell side analyst is anybody who is an analyst on the sell side. For instance, equity research analysts who try to think of investment ideas and then pitch and recommend these ideas to other investors. Investment bankers are also considered to be on the sell side. So they are sell analysts as well, because here again, they are trying to come together and try to sell a product. The buy side analyst, again, similar to everything else, is just an analyst who works for the buy side. These are employees, analysts, and professionals who are employed by the institutional money managers for proprietary research ideas to generally and internally generate ideas for their fund. The history of investment banking. Undoubtedly, investment banking as an industry in the United States has come a long way since its beginnings. Here's a brief review of the history. 1986 to 1929. Prior to the Great Depression, investment banking was in its golden era, with the industry in a prolonged bull market. J.P. Morgan and National City Bank were the market leaders, often stepping in to influence and sustain the financial system. J.P. Morgan, the man, is personally credited with saving the country from a calamitous panic in 1907. Excess market speculation, especially by banks using Federal Reserve loans to bolster the markets, resulted in the market crash of 1929, sparking the Great Depression. 1929 to 1970. During the Great Depression, the nation's banking system was in shambles, with 40% of banks either failing or forced to merge. The Glass-Steagall Act, or more specifically, the Bank Act of 1933, was enacted by the government with the intent of rehabilitating the banking industry by erecting a wall between commercial banking and investment banking. Additionally, the government sought to provide the separation between investment bankers and brokerage services in order to avoid the conflict of interest between the desire to win investment banking business and duty to provide fair and objective brokerage services. In other words, to prevent the temptation by an investment bank to knowingly peddle a client company's overvalued securities to the investment public in order to ensure that the client company uses the investment bank for its future underwriting and advisory needs. The regulations against such behavior became known as the Chinese Wall. 1970 to 1980. Considering the repeal of negotiated rates in 1975, trading's commissions collapsed and trading profitability declined. Research-focused boutiques were squeezed out, and the trend of an integrated investment bank providing sales, trading, research, and investment banking under one roof began to take root. The late 70s and early 80s saw the rise of several financial products such as derivatives, a high-yield structured product which provided lucrative returns for investment banks. Also in the late 70s, the facilitation of corporate mergers was being hailed as the last goldmine by investment bankers who assumed that Glass-Steagall would someday collapse and lead to a securities business overrun by commercial banks. Eventually, Glass-Steagall did crumble, but not until 1999, and the results weren't nearly as disastrous as once speculated. 1980 to 2007. In the 1980s, investment bankers had shed their stodgy image. In its place was a reputation for power and flair, which was enhanced by a torrent of mega deals during widely prosperous times. The exploits of investment bankers lived large even in the popular media, where author Tom Wolfe in Bonfire of the Vanities and movie maker Oliver Stone in Wall Street focused on investment banking for their social commentary. Finally, as the 1990s wound down, an IPO boom dominated the perception of investment bankers. In 1999, an eye-popping 548 IPO deals were done, among the most ever in a single year, with most going public in the internet sector. The enactment of the Gramm-Leach-Bailey Act, GLBA, in November 1999 effectively repealed the long-standing prohibitions on the mixing of banking with securities or insurance businesses under the Glass-Steagall Act, and thus permitted broad banking. Since the barriers that separated banking from other financial activities had been crumbling for some time, GLBA is better viewed as ratifying rather than revolutionizing the practice of banking. That's pretty much it for a brief history of the investment banking industry. In the coming section, we'll learn how to land a job in investment banking. I'll see you there. The classification of investment banks. The firms engaged in the investment banking industry are commonly classified into three categories: bulge bracket banks, middle market banks, and boutique banks. Bulge bracket investment banks ask an excellent question. Does size matter? The answer is maybe. Bulge bracket investment banks are considered traditionally the largest firms in underwriting syndicate. That's why it's called the bulge bracket, bulge for big, and in that little bracket in which the largest firms participating in that particular underwriting syndicate to help issue the equity or the debt. However, the now common layman definition in common language is that bulge practice simply means the largest, most distinguished and preeminent firms on Wall Street. Within the bulge bracket, there are also several tiers. Tier 1 might be considered the largest firms. You have Goldman Sachs, Morgan Stanley, JP Morgan, Credit Suisse, and Deutsche Bank, for instance. The Tier 2 firms, well, because they are slightly smaller firms but still very sizable, but perhaps just don't have the breadth and scope that the Tier 1 ultra-large firms have. So whenever you hear that term bulge bracket investment bank, that typically refers to the largest, most prestigious firms out there. And again, within there are also several different tiers. Now, another common term here that most people are generally wondering exactly what it means is the middle market. The middle market simply means that the market is in the middle. Now, it's kind of funny, and they don't really tell us too much about it, but actually, it's pretty accurate. These are the small, mid-sized firms, typically defined anywhere between $1 to $100+ million of revenue, or anywhere between 10 plus to about $500 million of value. Now, various definitions will come about based on who you talk to, but the general idea is that these are not tiny mom and pop shops, but they're sizable firms, but not that large. The middle market tradition has always been underserved because the big boys or the bulge brackets typically want to get higher fees, so they're going to go ahead and place a deal team to work on a deal. There's a lot of opportunity cost behind that. They want to make sure that the fees are high enough because working on a deal in the middle market can be just as sometimes or even more difficult and time-consuming than working on a large transaction. Therefore, typically, the middle market is considered to be underserved. Hence, you have a lot of these boutique investment banks who now try to focus and fulfill this particular sector or initial niche or market. Now, what exactly is a boutique middle market investment bank? Again, This is your small investment bank that is catering specifically to this underserved middle market segment. Boutique investment banks are not a high-end clothing store. So what are they? They are typically small and very specialized investment banks focused on a particular industry sector or niche. Many times, firms do not like to be considered boutique. They like to say they are full service. But at the end of the day, like it or not, the layman definition of boutique simply means that you have a very specific industry, focused industry sector or niche, typically speaking. Because they are a smaller firm, they do not have a large institutional relationship. In other words, they don't have the distribution force to push and sell equity and debt. Therefore, these boutiques typically end up being traditional mergers and acquisitions advisory firms, only because they do not traditionally in any way have access to a lot of capital. Therefore, that's where if you have a smaller firm who is full service, they can provide the public securities issuance, then you may call them a full-service boutique investment bank.